You know, I was looking at some of the editors' picks last night. This is Sunday morning. Well, it's not Sunday. Yeah, it's Sunday morning. It's 11:30 a.m. And it just struck me. I think there's some good advice there. But and there's management. JoJo had one on management and how to manage your essentially your estate. You know, the money. When you make money, you got to follow it. The number of losses, all that. He does all that stuff. That's just fine. And there were some other ones there as well. And it occurred to me that I see the market much differently today than I did 41 years. It's over 41 years now, than I did 41 years ago. And so I see things differently, and I needed to, or I would never have been able to make money in the markets. So you do have to manage. You manage every trade. And it occurs to me also, there are a lot of things when you do this a long time, they become intuitive, instinctive. You're not really thinking out in great detail in a way to articulate what's going on in your mind when you make trade decisions. And yet, when you try to teach things to people, a lot of times the obvious things, it doesn't occur to me to say anything, but I'll show, you know, some of the things I focus on, gaps, you know, extensions. You see a couple here on the chart. You see, I'm going to show you some measured moves. And it just doesn't occur that you're not going to see what I'm imagining, what I think is obvious. It may not be obvious to you. And one of the tricks to trading, in my opinion, is to whatever your strategy is, assuming this is the assumption that it makes you money. Because if it doesn't make you money, it won't help you. You have to have a viable way of looking at the market and interpreting the market that has some level of objectivity. And how do I know it's objective? Well, if you use whatever you're using and you lose money, objectively, you shouldn't trade. You have to have something that's repeatable, and you'll never prove cause and effect. And some of those things are not obvious. You develop them when you develop your skills as a trader, and it takes years. Very few people do it right off the bat. I can't speak for the geniuses, but most people aren't geniuses. And what you want to do is learn how to trade so that you can make some money, so that you have a sense that the market's good for you, because if you put some time in it and you plan it, you figure out your risk reward and all that stuff and the other details, you can make some money for your lifetime. You're not going to, for a lot of people, they'll trade before they're ready to do it. A lot of people they just don't have enough money to do it. You can't, to start trading with a $10,000 trading account has horrendous statistics to it. Almost all traders with a $5,000 to $10,000 trading account, especially if that's all the capital they have, they fail at trading. The stats are horrible on it. And even of the few traders, since 80 to 90% of all traders stop trading and probably lose money and stop trading, that's 90%, close to 90%. They have a bad track record too, statistically, and even worse than that, it's not worse, but it's disappointing. Of the 10% or 15% who make money, they're not making millions of dollars. They're making something that's viable. Just because you're one of the 10% doesn't mean that you make a lot of money, but you're making money, and so you're not automatically, you know, Paul Tudor Jones because you're one of the 10%, and at least you're making money. So that's the gist of it. So what I want to do, since I told you about a spike, you listen to the other video. It's a reversal pattern. It means it's an impulse. It's a price dynamic, a market that quickly moves off the bottom and it moves to this black dashed line. That's a tell that the market is going to go higher, even though it may correct lower for a bit. And that the smart money, if you believe in spikes, and what some people might claim, the smart money is going to go long, but they'll trade fewer contracts because they know that the market can have a drawdown and they'll just scale in and out, and they'll compensate for the fact that the market might be overbought. I'm using my terminology, and that it might correct a little bit, but in the end, they want to be the buyer, not the seller. They're not worried on a big spike. This is where it stopped. This is I need to give you a daily chart. Spread it out here. So the market closed on this bar after it did this. They want to be long, and the way they get long will be variable, but we're going to claim it's going to be on the close of the bar. So you have a chance to get in the next day at the close of the previous bar, and then they'll manage it. And one way they'll manage it is if they go short, if they go long, they know there's a risk they'll go lower, but they know it's going to get up to an area like this. If they believe that's their spike from here to here, they think it's going to double. Now, some other trader might make the spike smaller. We could go on ad nauseum, but what's not intuitive for a beginning trader is that you buy here with a risk like this. And the reason why it's not intuitive, because if you generally pick new highs and you're not accounting for what your risk is, because if you're getting in here, you have a risk of a drawdown. And what happens with traders soon after they begin, it's amazing it doesn't happen sooner, because so many traders are breakout traders and they lose their money trading. So if you're a breakout trader here, you may be a breakout trader when it goes higher, but before the market goes higher, it goes lower. These are very big dollars when the market, this is Bitcoin. You have to know what the dollar amount is. So if you buy here, you have to take, assuming that it gets down to here because you're stopped out, you took a beating on this. So there are a lot of things about this, but I want to show you a way of looking at it if you're professional. So you trade 10 contracts mainly. You want in because it's a spike, you know it's going higher, and you're prepared because you have the equity and you have the skill. You'll scale in a couple contracts because in your mind, this is so important, you buy it. It's absolutely clear to you that you buy it, but you have to do it managing it. So let's look at it. Remember this dashed line, that's the entry line over here. Most traders that get in, I can only imagine, because I obviously don't know most traders, but most people get in. And I know in the beginning, for many years I'd get in and I worry about my entry. So I'm in the market and the market starts turning against me. And my focus is, well, how much do I want it to go against me? You know, and of course you can have a stop and other things. You learn how to do stops with time. But you're really all or nothing as a beginning trader. You're either short or you go long, and then you're kind of worried, am I in trouble with the trade? It's a very simplistic way with many variations, but you get what I mean. With somebody who's buying at this black line, because they're a pro, is they know, well, the market can trade lower, but it's going to go higher. So what I'll do, I'll trade less volume. I'll trade one chart, one contract, and I'll scale in it, and to varying degrees, they may scale out. And that's variable. I can't tell you every scenario. But in a market that opened, you got in here and the market went down here, you could be making so freaking much money for what it's doing and have no loss because you scaled. Whereas the person, if they buy here and they have to make a decision where their stop is, if it gets down to here, this is a killing in this. You have to, well, it's a killing. I'll show you some price numbers on this. So you're thinking differently when you're a pro because it's a more complex, in some ways more subtle way of trading, but you have the capital, so you can add capital and you can scale. It's a totally different way in the market. It's a totally different feel for the market, and it's very comfortable as long as you can add contracts judiciously. And what are difficult traders for one contract traders or traders that are all or one. I'm all in or I'm all out. It's my stop, that's my target. It's a much harder way to live, but it takes more capital to trade and scale. So let me show you how you can make money, because if you got long here, before the market really made you money, if you didn't scale, was when the market did this, okay? But for somebody who scales, let's look at the market. This is a 4-hour chart. So you get in at the dashed line. You get in at the close of the first bar, one contract. The market goes lower. When the market goes lower, it closes the gap higher. See closes the gap higher. You could go long there. So if you had two contracts, one that was here and one you got in here, the market corrected, you're net long, you're net positive. Now you could scale in and out of it or not, but if you were adverse to drawdowns, if you got out here, you basically made all your losses back and then some. So you're net positive if you close one of your contracts and keep the original contract. You're making money. The market goes lower. It goes to the 1.272. This is a reversal pattern. For me, it's a reversal pattern because it's a reversal pattern, but it's basically testing the bottom part of a range. That's how I would look at it. But it's the 1.272. I would get into that. Now, if I stay with this contract, I could get out here and I make money. It depends. Let's just make it easy. I get into this contract and I believe this is a support and I play it to double the range box. Range box, it doubles it. It trades to a gap lower. Now these are my tools, so I'm giving you my experience that before this video, I didn't figure it out for you because I'm not thinking to scalp this market. I'm just telling you it's a big impulse. It's going to go up here. But I thought maybe I better tell you how, as a professional trader who's committing money to it, how the professional can scale and make this a much different experience than all or none. You get in here, you got to take a crazy stop, you're sweating your butt off, and you haven't done anything in a market that gives you opportunity. I think you understand what I'm saying, but it goes to here. So what does it do? It goes to the ABCD pattern. If that's what you use, B gets you there or closes the gap, you could use either one. Now I would see the gap because I don't have to draw anything. I'd see the ABCD because I don't have to draw anything. But what I really do is see that it's a measured move. That's what I'll see. If I'm in a room by myself and I'm not doing videos, this is what I'll see. I'll also see the 1.272. I'll see this move above here as a measured move, and I'll see the gap. I'll see all of this. And if I'm scaling in and out, I can make money on it. If the market moves to here, it's just retesting a support area. I might take a trade there or I might not. The market goes to here. I could add a contract. If I'm scaling. If it goes lower and I didn't take my profits, well, I'm scaling. I'm going to kind of trade scaling. If I buy here and I'm already, it depends on what it depends. Am I in the market? Did I take my profits here when it goes to here? It depends. But when it goes down here, it's a double bottom. You can buy that market and it has a move like this. When it goes lower, it's basically a breakout failure of the range box. It's not a perfect double bottom, but it's a lower double bottom to this. And in my mind, I don't think the market's going to do this and go lower. What I think is, without all the details of how you could have scaled and had a totally different experience because you were willing to scale in and out, and basically you make money left and right in a market that you thought was going higher but it nailed you a couple times, and then it went higher, and then if you didn't scale, you take drawdowns. You know, I mean, there are details. This is a well, it's not quite a measured move. It's not really quite a measure. It goes from here. I shouldn't do this, but I started it, so I'll do it. Just make sure I have the right tool. So the market goes, it's more than a measured move, but I'll show you. It goes from there to there. That's your correction. Then it goes lower. It's a double buy. I'm going to buy in here. If I have a hair up my butt, I buy here in a buying tail. Or the next day or the next bar, it's not a daily chart. It goes a little bit lower. It's a double bottom. Maybe I'll buy here or here for different reasons, but the market's finding generally a support area and it's trading higher. Remember, from my point of view, this is going higher. And I need to say this quickly before I run out of time. Part of the way I'll trade this, if I'm trading it, if I'm scaling with it, my core belief is this is so important, the market's going to go higher. I also believe when I get in here, if I'm in here and it goes here, I have to decide if I'm going to get out or I'm going to take the drawdown. Because I know that when the market does all of this, and there are other reasons why it may go to here, you have to look to the left. I'm not going to do it here. But I know just because the market goes from here to here, if I haven't taken my profits sooner or later, it's going to correct lower. I don't know how much lower, but it's going to be, it could be anything, but it's going to be lower. I know it, you know it. When you start seeing this, you're worried that you got in the market here. You haven't done anything up here. You know that there's a good chance it could correct. You know it, I know it. But you want to think about it as a buyer and a seller and have a pattern of thinking and understand some dynamics behind the market so that you can make decisions. If you can only play one contract at a time and that's it, there's not much you can do other than you stay in or you get out, and then you get in at another time. When you're scaling and you're making money when the market's doing some of this stuff, it gives you more leeway, and you should be knocking out, if you're scaling, you knock out trades because you're thinking, I don't want to say more scalping, but you're trading the patterns, and your risk reward is more complicated. But in general, when a market does this, I think this market, when I see it here, needed more buyers. And my thinking is they needed confirmation that the market was going to do more, but they're getting in too late. And so I'm in here. I think they're going to take out these breakout buyers. That's what I think before anything else happens and there's a correction to a support area. And then then for me, whether I get out of a market up here, I'm hoping I get out. It's a chance for me to get back in. It's not really scaling per se, but I want you to see what I see when I'm looking at what I'm looking at. And then when the market goes to here, not that I know it's going to do it, if I take a trade down here, maybe I will or will not take profits, or I'll trade it higher. But when the market goes higher, there are more breakout buyers. They're going to get hurt in the market. Why? Because the market is expanding higher. It's creating a low, high, higher, low, higher, high, and it's coming to resistance area. And yes, there are still sellers here. So when the market reverses, and I believe the market's going to go higher, it's basically this is the first part of the swing. I don't mean this swing, trending swing. It's the first part of when the market trades lower, and it did, because there were breakouts buyers, and they did get killed in the market. But maybe you could buy it here, maybe not. It's testing it, but it's a failure. It's tricky. It's going to have a small trend lower. Comes 1, 3, 5. It's even going to trade lower. 1, 2, 3, 4, 5. But when a market starts doing this, my thinking is the market. This is a first swing. The second, the third swing is here. I won't get it off most likely, but I look for the market. I won't get it off. A, B, C, and the market goes to a pattern up here somewhere. we're out of time.